Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we recap recent events, preview what's on the horizon, and share some interesting charts that caught our attention.
Welcome back for the deep dive this week. All right, everybody, get ready, because today we are diving headfirst into some really interesting economic waters. And, well, you all send over some articles and data points that have us scratching our heads a little.
Yeah, it's a real head-scratcher.
A strong job market,
Yeah.
stock market that's all over the place. It's
Yeah.
enough to make anyone wonder if we're heading for a boom or a bust.
Right. Like, what's the real deal here?
Exactly. And to help us figure it all out, we've got our economic expert here who's kind of amazing at connecting the dots and seeing the bigger picture.
I try to connect them at least.
Well, you do a great job.
Yeah.
So let's start with this piece from Weekly Notes that really caught my eye. It talks about how different this economic recovery is. We're seeing wage growth and unemployment drop at the same time. And like, nobody's seen this in 40 years, at least not quite like this.
Yeah, that's pretty unusual.
Right. They even pointed out that when we were at this point in the recovery from the Great Recession back in the day, the unemployment rate was still something like 8.2%.
Ouch.
So, are we in the clear now? Is this good news we can finally celebrate, or is there something else going on here that we're missing?
Well, that's the million-dollar question, isn't it? I mean, at first glance, yeah, seeing unemployment drop that fast while wages are going up, that sounds like a dream come true. But like with anything that changes this quickly, you got to ask yourself what's making it happen. And more importantly, can it last?
So what is driving this crazy trend? Is it actually sustainable, or is this like a sugar rush before the crash?
Yeah.
And what does it mean for everyone out there listening? Like, should we be updating our resumes or what?
Okay, so a few things are probably playing into this. One is pent-up demand after the pandemic threw everything out of whack. People were ready to spend, businesses were scrambling to catch up. That creates a perfect storm for hiring like crazy and, of course, higher wages.
Right. Makes sense.
But, and this is a big but, especially for your listeners, this might not be the new normal. If businesses start feeling the squeeze from these high interest rates, or if people suddenly decide to close their wallets, well, hiring could come to a screeching halt. So yeah, the job market looks pretty sweet right now, but it's always smart to have a backup plan, just in case.
Okay, so maybe polish up those resumes just to be safe. I like it. All right, so the job market's looking kind of good, maybe. But what about the stock market? Shouldn't it be doing a happy dance too? This JP Morgan chart with the S&P 500 PE ratios has me a little spooked.
Oh yeah, what's that one showing?
Well, it's got the forward PE ratio at 21.5x, and historically when it gets that high, let's just say future returns haven't been pretty, especially over a 5-year period. So, warning sign. Are we in trouble?
Well, it's definitely something to keep an eye on. Don't forget, the PE ratio, that price to earnings thing, it basically tells you how much investors are willing to shell out for every dollar a company makes.
Right.
So when that ratio gets really high, it could mean investors are super optimistic about future growth, which, hey, sometimes that pans out. But it can also be a sign of, irrational exuberance. Do you remember the dot-com bubble?
Oh, yeah. Yikes. Are you saying we might be in another bubble situation right now?
It's way too soon to tell for sure, but that high PE ratio plus the Fed raising interest rates like crazy, yeah, it's definitely raising some eyebrows. Speaking of which, check out this chart from Opening Bell Daily. It's got the S&P 500 performance right alongside those Fed rate hikes.
Okay, I've seen it.
What's wild is that even with those rate hikes, the S&P 500 is still going up. And usually that's not how this works at all.
It's like the market's decided to throw out the rule book.
Yeah.
So how do we even begin to understand this? And what does it mean for, regular people trying to figure out their own investments?
So one possibility is that the market already factored those rate hikes in. Like investors saw them coming and adjusted their game plan.
Yeah.
Another possibility is that companies, especially those tech giants, they've figured out how to deal with higher borrowing costs. So it's not hurting them as much. But, and this is a big but, it doesn't mean we're home free just yet. If interest rates stay high for longer than people think, or if some of those high-flying companies start to falter, we could be in for a correction. So, yeah, it's tempting to chase those quick profits, but honestly, having a diversified portfolio and thinking long-term, that's always a winning strategy.
Okay, so we've got this job market that looks good on paper, but who knows, right? And then this stock market acting like it's on another planet. And then there's the whole interest rate thing, which could really throw a wrench in everything. Makes me want to play it safe,
Yeah.
And I always come back to those boring but essential consumer staples.
Oh, you mean like the stuff we literally can't live without?
Exactly. Food, drinks, cleaning supplies. It's like that old saying, when times get tough, people buy more toothpaste.
Huh. There's definitely some truth to that. Those consumer staples, they've always been seen as a safe haven during uncertain times, and for good reason. I mean, it doesn't matter what the economy is doing. People still need to eat and drink and, keep their homes from falling apart.
Right. And this chart from Kailash Capital Research,
Yeah.
it really drives that point home. It's got these price to sales ratios for different sectors going all the way back to 1984, then 2022, and now. And let me tell you, the difference between staples and tech, it's kind of shocking, like comparing apples and oranges, or maybe like a loaf of bread and the latest smartphone.
Yeah, it's a stark difference for sure. And to me, it says that maybe, just maybe, staples are due for a comeback. Remember, tech has been the darling for a while, but those crazy high valuations, they can't last forever. We've seen it time and time again.
So what, are you saying I should sell all my tech stocks and go stock up on groceries or something?
Not necessarily. It's all about balance, right? You got to figure out your own risk tolerance, how long you're planning to invest. But when you look at how those consumer staples have held up during tough times, I mean, high inflation back in the 70s and 80s, the dot-com bubble, the whole 2008 financial crisis, they offer a level of stability that's really appealing when everything else feels shaky.
Yeah, that makes sense. It's
Huh.
like having that one reliable friend in your life. You know they've got your back no matter what craziness is happening. But speaking of craziness, can we talk about this election for a minute? It just feels like one more thing to worry about.
Elections always add a layer of uncertainty, that's for sure. But historically, it seems like those consumer staples, they just roll with the punches no matter who's in office.
Well, I'm looking at this chart. It shows how XLP, that's the Consumer Staples ETF, performed compared to XLK, the technology ETF,
Hmm.
6 months after every presidential election since 2000. And yeah, XLK, the tech one, it's usually done better, especially lately. But something tells me this time might be different, with everything else going on.
You could be right. I mean, we're in uncharted territory in a lot of ways. The economy's doing its own thing, interest rates are a wild card. And then you throw this election into the mix. It's definitely a time to pay close attention, maybe rethink your investment strategy depending on how much risk you're comfortable with. Because remember, those historical trends, they're interesting and all, but they don't guarantee anything about the future.
That is for sure. Speaking of wild cards and unpredictable things, can we talk about crypto for a minute? Bitcoin's been on a roller coaster ride, hitting these new highs all the time. Ethereum, it's down 50% from its peak, but everyone's still talking about it. And then there's the whole thing with both presidential candidates saying they want clearer rules for crypto. What do you make of all that?
Crypto, right. Never a dull moment.
Right.
But you're right, that regulatory landscape, it's a big deal. And the fact that both candidates are talking about it, saying we need clearer guidelines, that's actually huge. It means crypto's not this fringe thing anymore. It's becoming too big to ignore. And honestly, mainstream adoption might be closer than we think.
But isn't regulation kind of a double-edged sword? I mean, yeah, it could bring more legitimacy and stability to crypto, which could attract more investors. But some people are worried that too much regulation could stifle innovation, slow down all the progress that's been made so far.
You hit the nail on the head. It's a tough balancing act. And how these regulations are written, they could make or break the whole future of crypto. And what's interesting is that each candidate seems to be coming at it from a totally different angle.
Yeah, and that has me wondering, especially with this election coming up, how each candidate might approach this whole crypto regulation thing. You were saying they're coming at it from totally different angles.
Well, yeah, you've got Trump. He's been pretty upfront about being pro-crypto. Seems like he'd prefer a hands-off approach to regulation, kind of let the market figure things out on its own.
Right, which makes sense thinking about his overall stance on, the economy in general.
Exactly. But then on the flip side, you've got Harris. Her campaign put out a statement recently saying that she sees regulation as really important for protecting investors, especially black men, because, more and more of them are putting money into crypto these days.
So it sounds like she's really focused on consumer protection and maybe trying to make sure everyone has equal access to information about crypto no matter who they are. It's amazing how this one issue, crypto, it kind of highlights these completely different approaches to economic policy. Tough to tell.
But hey, while we're talking about things that make you go, have you seen this trend with PIK loans? Got me curious. What even are PIK loans anyway, and why is everyone talking about them?
PIK loans, those are a whole different ball game. You know how you usually make interest payments in cash? Well, with these PIK loans, short for payment in kind, companies just tack that interest onto what they already owe, like hitting the snooze button on your debt, but that alarm just keeps getting louder.
Sounds a bit like financial Jenga.
Mhm.
And then we've got these charts from Moody's showing how much PIK income those business development companies, the BDCs, are pulling in. And, well, it's higher than it's been in years. What's that tell us? What's going on in the economy?
Could be a sign, right?
Right.
Some companies are feeling the squeeze. Short-term solutions instead of dealing with those interest payments head on doesn't mean everything's going south, but it's definitely something to watch. If more and more companies jump on this PIK loan train, yeah, it might mean trouble's brewing. Okay, so deep divers. We've navigated those potential market bubbles, we've talked tech versus staples, and dipped our toes into the PIK loan pool.
Complex topic. We've got some really fascinating research from economists over at Brookings about the potential economic impact of renewables. And I gotta say, some of these numbers were pretty eye-popping. Cheaper electricity, more jobs, higher wages. I mean, it almost sounds too good to be true.
Well, I think it's easy to be skeptical, but the research really does point to some pretty significant potential benefits. For example,
Yeah.
they suggest a possible reduction in U.S. wholesale electricity prices of somewhere between like 20 to 80% by 2040.
Okay, hold on. Wholesale energy prices. I think we got to break that down a little bit because, to be honest, that sounds like something that only economists really understand. What does that actually mean for, like, everyday people, for our listeners?
You're right. Sometimes we get caught up in the jargon. Basically, we're talking about the price that the utility companies are paying to the electricity before they sell it to you and me, before
Yeah.
it gets to our homes and businesses.
Okay, so if those wholesale prices go down, theoretically, our energy bills should go down too.
That's the general idea, yeah.
Okay, all right, that makes a little more sense. But I got to ask, WHY, would switching to, wind and solar, why would that have such a dramatic impact on those prices?
Well, at the risk of sounding too simplistic, sunshine and wind are free.
Hmm.
Obviously, there's an upfront cost, right?
Hmm.
You got to get those solar panels, wind turbines, all that infrastructure in place. But once you've made that investment, the energy itself is essentially free, which is a very different story than fossil fuels, where you're constantly paying to extract them, transport them, process them.
It's like investing in a really nice high-tech solar oven. Yeah, you got to shell out some money up front to get it, but after that, free cooking energy from the sun.
Exactly. And so now imagine you're a manufacturing plant, let's say, somewhere in the Rust Belt. And suddenly, your energy costs get cut in half. I mean, that changes everything. Suddenly, you're way more competitive. You can invest in new equipment. You might even be able to hire more workers because you've got all this extra cash on hand. And that's the kind of ripple effect that we're talking about here.
And those ripple effects could spread throughout the whole economy, right? Because in theory, if businesses have higher profits, then they tend to hire more, which then leads to those wage increases that the research was talking about.
Precisely. And, it's not even just about the immediate impact on jobs and wages. The Brookings paper really emphasizes this idea of what they call a massive reallocation of resources. Because right now we spend so much time, money, and brain power just trying to be more energy efficient because
Mhm.
fossil fuels are so costly.
So you're saying that if we weren't so busy, trying to squeeze every last drop of efficiency out of our current system, we could be focusing on entirely new forms of innovation, entirely new ways to make progress as a society.
Exactly. Exactly. It's like we've been running this marathon, but we've had these ankle weights on the whole time. And now we have a chance to take those weights off and just see how fast we can really go. It's a pretty exciting prospect.
Okay, so we've talked about some of the big picture economic stuff, but now I'm really curious about like the geographic side of this whole thing. Where will these changes actually play out? And to help us kind of visualize that, you sent me this really fascinating map. It shows where all the data centers are currently located across the US, and I have a feeling this is where things are going to get extra interesting.
Yeah, you're telling me, I mean, this map is really key to understanding how the renewable energy landscape might actually shift, geographically speaking.
Yeah.
Because where these data centers are, and probably more importantly, where they get built in the future, that's going to be deeply connected to, the availability of clean, affordable energy.
So walk me through, what are some of the key things that kind of jump out at you when you look at this map?
Well, the first thing that I think might surprise some people is just how much electricity these data centers consume. I mean, it's a mind-boggling amount of power, and it's only going to go up as we, you know, become more and more reliant on all these digital technologies.
Right. We talk about the cloud as if it's this, intangible thing, but All those servers, all those computers, they're physically located somewhere, and they need a lot of juice to run 24/7.
That's right. And so when you look at this map, you start to see some interesting patterns emerge. For example, you might think, okay, California, Silicon Valley, that's going to be the data center capital of the country, right?
Yeah, that was my first guess, too.
But as it turns out, Virginia actually takes the crown. They've got a whopping 26% of the nation's data center power consumption happening right there in the state of Virginia.
26%. Wow, I had no idea it was that high. What makes Virginia so attractive for data centers?
It's a few things. First of all, they've got a lot of the infrastructure already in place that data centers need. Things like fiber optic cables, you got to have that super high-speed internet, and increasingly access to renewable energy sources becoming really important. Plus, the cost of land in Virginia is relatively cheap compared to a place like California, and they've also been very strategic about attracting companies with, favorable tax incentives and things like that.
So it sounds like kind of a perfect storm. They've got the infrastructure, they've got the price point, they've got a friendly business environment.
Exactly, and it really highlights how much the economics of renewable energy are going to start influencing where businesses decide to locate, where they decide to set up shop. I mean, states that can offer that abundant, affordable, clean energy, they're going to be incredibly attractive to these data-hungry industries.
Yeah, it's almost like we're witnessing a new kind of industrial revolution, only this time it's powered by data instead of, coal or oil. And just like the original industrial revolution, led to the growth of certain cities, certain geographic regions, it seems like this digital revolution is poised to do the same thing.
Yeah, that's a great analogy.
Huh.
And, it's not even just about the data centers that are already up and running. This map also gives us a little glimpse into how things might shift in the future.
Mhm.
So let's take Texas, for example.
Mhm.
They're only at 2% right now on this data center power consumption map, but they've got tons of land. They're already a huge player in the energy sector.
And they're already seeing a ton of growth in renewable energy, especially wind power.
Right, exactly. And they're actively trying to attract more data centers,
Hmm.
tax breaks, incentives, the whole nine yards. So it's not hard to imagine a scenario where in the next decade, Texas goes from 2% to, who knows, maybe 7, 8, 9%, even 10%. I mean, that's a huge potential jump in energy consumption from data centers alone.
That's a game changer. And it really drives home the point that this shift toward renewables, it's not just some abstract environmental thing. This is about the economy. It's about potentially reshaping the entire political map of the country.
Oh, absolutely, yeah. States that, 20, 30 years ago might have been completely reliant on, coal or natural gas. They're now realizing, hey, this is our chance. This is our opportunity to be a leader in this new clean energy economy.
This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.